If your goal is to replace your income with cash flow, you're in the right place. In this video, I'm going to walk you through my personal take on market timing and when I think you should jump in. I'll show you why low interest rates don't automatically mean a good deal and why high rates don't automatically mean a bad deal. I'll show you how I bought a property in a high rate market that appraised for over $170,000 more in just 6 months. So if you're a healthcare provider trying to build cash flow outside the hospital, make sure you hit that like and subscribe button because this channel is about buying assets that buy back your time. Let's get into it. I'm sure you've all heard that proverb, the best time to plant a tree was 20 years ago, the second best time is now, and real estate is obviously no different. Everyone wants to buy at the right time, but there is no right time. We wait for rates to drop, we wait for prices to correct, for headlines to calm down, for a new president, whatever it is, and while we're waiting, time passes, and we just miss out on appreciation and equity. You are never going to get low prices and low interest rates at the same time. It's usually one or the other. So you've got to pick your lesser evil. So I'll show you why I picked a strategy and how it's working for me. So when interest rates are low, we all saw this back in 2021. Buyers flooded the markets. Monthly payments looked cheaper and helped people to afford more house and a bigger price. Emotions were surging. That's when bidding wars were happening. People waived their inspections and they covered their appraisal gaps. Things were being offered well above asking price, hundreds of thousands of dollars sometimes. And if you have an asset to sell, this is a great time to sell to take advantage of frenzied buyers. But we aren't talking about selling. We're talking about building our portfolio and jumping in and buying. So in 2001, before I decided to get into real estate investing, I was looking at a house for myself. I had my eye on this one specific house that was in the mountains. It was gorgeous. They had priced it at my $1.5 million maximum. So I went ahead and put a bid in. But whenever I went to the showing, there was so much interest. It was like an open house every day. They received over 30 offers and it sold for $590,000 over asking, well over $2 million. A few years later, it went back on the market and they kept dropping the price far below what they paid, and eventually they just pulled it off the market. I don't know what it appraised for, but I'm willing to bet they overpaid and will have to wait several years for the market value to catch up to that price. So keep in mind, you can refinance a terrible interest rate, but you can never refinance overpaying for a property. If you're overpaying in a bidding war, you are paying interest on that difference for decades in addition to the difference in price and value. That number does not disappear. So let's flip it. What do we do when interest rates are high? Demand cools off. Fear starts to creep in. Buyers are hesitant. Sellers get nervous that they won't even get a buyer. Stuff sits on the market forever, but something else happens. Negotiation returns. Properties sit longer and sellers will get more flexible. You can ask for concessions. You can buy for under asking. Warren Buffett has his famous quote, "Be fearful when others are greedy and greedy when others are fearful." This is the perfect time to buy, in my opinion, when rates are getting high. Yes, your rate will be higher. Your payment may be uncomfortable for a little while, but if you can get in for under asking price, you're going to acquire the asset at a lower price and you'll pay interest on that lower price for the life of the loan. So when rates fall later, because they will, they always do, that's when you refinance. So now you've ended up with the best of both worlds. You got a cheaper purchase price, and then a few years later, now your rate is refinanced and you have a lower monthly payment. So over the life of the loan, that math will look very different. So one example is the most recent property I purchased. When it first came on the market, it was a lower rate time. So there was a bidding war above $800,000. So unfortunately for the sellers, the winning bidder, their financing fell through. So whenever they went to the backup, they had already moved on to a different home. So then it ended up sitting on the market for several months. No fault of the sellers or the property, but it doesn't look good when it's been sitting there for a while. So the seller was forced to keep dropping the price, and I was able to snag it as rates started to rise, less buyers on the market, I bought it for $702,000. So in the next 6 months, I made a few changes. I changed the banister on the stairs. I added kitchen drawer pulls, which is like nothing. I installed a tankless water heater because unfortunately 3 days after I closed, the 23-year-old water heater went out, but I knew that would probably happen. And then in the laundry room, I just ripped up some ugly linoleum. So I spent probably less than $10,000, and then 6 months later had it reappraised, and it reappraised for $875,000. You make money when you buy the house. So make sure that you are purchasing it at below value if you can. So when rates start to rise, I get a little excited because you can usually find something with negotiation leverage. If I can buy below intrinsic value and the numbers work, I'm going to tolerate temporary discomfort until I can refinance a few years later to get better terms, because I really don't want to overpay and I don't want to pay interest on what I just overpaid. So if you're a clinician who wants to replace shift income with cash flow, make sure you hit that like and subscribe button. We're going to do some honest breakdowns like this. And if you found this helpful, put a comment below. Would you rather buy in a low rate bidding war or a high buyer's market? I want to hear your thoughts and strategies.